It's Wells Fargo's crash warning that a hard landing is coming. I'm your host, Steven Van Metre, and thanks for joining me today. First it was Bank of America, then it was Goldman Sachs. Now Wells Fargo is saying that a recession is unavoidable, and as things for consumers are showing signs of getting worse and fast. Let's head over to Wall Street Journal where we picked this story up. The U.S. economy is headed for a downturn, Wells Fargo CEO says. It's going to be hard to avoid some kind of recession. Wells Fargo CEO Charlie Scharf said Tuesday there was no question that the U.S. is headed for an economic downturn. The Federal Reserve has raised rates twice this year and plans to keep doing so, part of its bid to cool the economy and curb red-hot inflation. Higher rates have pushed up borrowing costs for mortgages, credit cards, and other loans. The Fed's move to raise question whether the U.S. is headed toward recession, which some investors fear could happen if the Fed raises rates too quickly, which they're going to do in less than 2 weeks, or less than 4 weeks. It's going to be hard to avoid some kind of recession, Mr. Scharf said. But Mr. Scharf also noted that consumers and businesses are still financially healthy by many measures, a view that we're going to take challenge in today's show. The fact that everyone is so strong going into this should hopefully provide a cushion such that whatever recession there is, if there is one, is short and not all that deep. Banks are often viewed as a proxy for the wider economy. Concern that central banks' tightening will hamper economic growth has driven down stocks of major banks, including Wells Fargo. And then when we talked about on yesterday's show how a housing crash is likely to come, and we see the refinance applications, the bread and butter of Wells Fargo business, are crashing to near historic low levels, well, it tells us that if banks are a proxy for the economy, and banks are in trouble, and so too is the economy. Let's continue on because Target, Walmart earnings sell-off puts retailers' inflation pains on display. So Charlie, we're going to challenge your view that the economy is actually in pretty good shape. Higher costs on fuel, products, and wages prompt some companies to rethink when to raise prices further. Inflation is catching up with some of America's biggest retailers as their recent quarterly results were pinched by higher costs on everything from products to fuel. Investors dumped shares of Walmart and Target and other big chains, notching some of the biggest declines since the market crash of 1987, amid fears that companies wouldn't be able to pass along higher prices to consumers. It also stoked concerns that through financial markets about the resilience of companies that collectively employ millions of workers in the U.S. and abroad. We're really in an inflation scare this year, and essentially the concern is that the Fed is going to aggressively choke out growth as well as inflation, according to a strategist at Naxos Investment Managers. And as we know that when growth and inflation expectations fall, what does that mean for stocks? They go down. What does it mean for interest rates? They also go down. And that's the story investors get wrong because they ditch their bonds thinking that inflation is going to continue higher. But when growth and inflation expectations roll over and head lower, it's a boom for the bond market. Let's continue on because Target shares tumbled a whopping 25% after the retailer posted weaker than expected quarterly earnings. It said it would rather absorb higher costs. Now, no business would rather absorb higher costs. There isn't a business in this world that said, hey, my prices are rising and I will not pass those on to consumers. The reason they're absorbing them is because they already know they can't pass them on. I want you to understand that. They cannot. Target management said fuel and freight costs will be $1 billion higher this year than expected, with little sign of their easing this year. So again, as Charlie, the CEO of Wells Fargo, said the consumer and economy in great shape, this tells us it's not. And while we don't like the impact on our profitability in the short term, we know this is the right thing to do for our guests and our business over the long term. Analysts said that weaker results showed that consumers were beginning to curtail spending amid higher prices. See, Target and Walmart, they already know this, as underlying volumes are looking really soft. This is the beginning of a consumer pullback, and one that is led by the stock market. Just check this out. A chart we looked at recently, the Wilshire 5000 full cap price index against advanced retail sales, both on a year-over-year rate of change. And you see as the equity market goes down, well, so too does spending. And it only makes sense. You see equity market on a year-over-year go down, retail sales on a year-over-year goes down, in this case contracted, and you see it happen over and over. Stock market goes down, spending slows. Market down, spending contracts. Market going negative here on a year-over-year rate of change, it's going to pull growth down in retail sales. Now, if you think about this, is all about the wealth effect. We go back to Alan Greenspan, and I want you to understand, if we compare, say, a household that has a $50,000 a year income versus one that has a $500,000 a year income, now who is the biggest consumer? Now, if you said, well, based on the percentage of their income, well, then it would probably be the household with $50,000 a year of income, particularly if they had a couple kids. Their odds are they're spending 100% of what they make, maybe even more some months as unexpected expenses come along. But in terms of who is the biggest consumer, well, that's the $500,000 household. Look at the homes they own, the cars they drive, the clothes they wear, the vacations they take, the food they eat. They are much larger consumers, and their spending, even though their income is more, their confidence always comes back to the equity markets. It goes down, well, so too does their spending, and that's what the Fed's after with its plans to bring the market down. Let's look further, because this will also bring down inflation as we see advanced retail sales here in red, still on a year-over-year rate change. And now we're going to overlay consumer price index. And again, as you see retail sales slow, lo and behold, then inflation comes down. Retail sales slow, inflation comes down. Retail sales coming down, inflation not yet, but it eventually will. And a lot of people struggle with this, but some people have never owned a business. And if you own a business and your products aren't selling, you don't raise your prices. You end up usually lowering them because you have overhead. You have your own income you need to worry about. You have your business expenses. You have your employees. And if you're not moving products, you're not making money, and you don't raise your prices, you lower them. And that's ultimately, again, why we see equity markets come down, retail sales come down, and inflation come down. Now let's continue on, because Americans continue to spend briskly in April. Now this would support the Wells Fargo CEO's view on products as diverse cars and clothing, which economists and company executives say is a sign that consumer spending is relatively healthy. But consumers are also showing signs they are less willing to absorb price increases and are trading down to less expensive items, according to retailers and manufacturers. Analysts are watching closely for any signs that the chains are starting to discount more aggressively. One possible trigger: Walmart finished the quarter with too much general merchandise inventory. Wait a minute, we keep hearing there's an inventory shortage, and yet Walmart, biggest retailer, now has too much. According to a Citi analyst, he expects Walmart to discount more, disinflationary, to clear the goods, which could place pressure on other chains, including Gap and Target, to do the same. Target and other retailers have benefited from rising sales of higher margin goods such as kitchen appliances, television sets, and furniture during the pandemic, and profits increased. But on Wednesday, the company said earnings for the April quarter were hurt by higher markdown rates, and inventory impairments, and lower than expected sales in those discretionary categories. And if you think this quarter is bad, well, wait till next quarter when the economy is really slowing down. And that's why you see headlines like this: Dow slides more than 1,100 points on the worst day since 2020, and more of those days are to come, as the results are prompting Wall Street to wrestle anew with the idea that the global economy could be headed for a recession. Though that debate is far from settled, it has roused stocks and other risky assets throughout the year, with the latest data illustrating the degree which inflation has hit U.S. consumers. And all of it's saying is a recession is highly likely. The Fed wants it. They're engineering this. And the only question now is, can your portfolio stand up to a recession? Or, well, maybe it's time to take a look at Portfolio Shield. I'll put a link up here in the corner and the description below. Its bond hedging is looking really great lately, and it is something worth looking at, because now jobless claims in the U.S. are at their highest level since January, indicating, as we talked about, the Fed wants to see people lose their job to slow down the economy, as initial unemployment's increased by 21,000 to 218 in the week ending May 14th. That was last week. The median estimate was 200,000 initial applications, which is super low. Historically, it's low, but remember, you have to come off of a bottom somewhere, and that number continues to rise. It just falls into line that a weaker stock market, slower sales, and that means less employees needed. But the good news is, for those on unemployment, we saw a drop of total claims of almost 69,000 last week, down to 1.371 million. Great news. But now we'll look at the Philly Fed, which is showing further signs of the economy slowing as the manufacturing activity in the region continued to expand overall this month, but at a whoppingly slower pace. You can see here in their chart The survey's current general activity index declined, while the indicators for new orders and shipments rose. The employment index decreased, the prices index remained elevated but edged down, and the survey's future index remained positive, and they always usually do. But here you can see general business activity on the diffusion index. You see it went from 17.6 to 2.6. That is a huge decline. Look at other declines. Inventories are declining 11.9 to 3.2. Prices paid down. This is a sign of disinflation. Also, a reason why you're seeing interest rates peaking. Prices received 55 to 51. How about number of employees? 41.4% of firms increasing now. Only 25.5% of firms showing a slowdown in employment. In the work week, this is going to lead to further unemployment. 20.8 firms showing an increase down to 16.1. So all signs point, again, as we get these warnings from the banks, and they should know because they have more data than anyone. The economy is headed into recession. The Fed, in less than 2 weeks, starts quantitative tightening. No, not easing anymore. They're going to tighten, and in less than 4 weeks, a 50 basis point rate hike. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.